Fantastic. Now we have a live question from Pedro. He raised a debt round a year ago, and he needs to raise more money, but but not enough to merit doing a priced round. What should he be thinking about if he wants to issue more convertible notes to new investors?
So this happens all the time. People raise convertible notes very early on. They're still building the business, not yet at a place where they're ready to put a valuation on the company, and they raise new notes. Without knowing the exact terms of the notes you used in the past, I can't say exactly what you should do, but it's very common to be able to use notes again on top of the ones you already did. You can have a new valuation cap. You can use a new discount. It doesn't have to be on the exact same terms. That depends on what your earlier note said, but generally you're fine to do more than one round of safes or notes, and they'll all generally convert at the same time when you finally do that priced round.
Great. Is ratchet common these days in preferred financing?
So that's a very different type of question, where that is really dealing more with later stage equity rounds, when companies are selling preferred shares for a specific price, and you usually only see a ratchet when a company is much closer to exit or IPO, when they're in a later stage. And what ratchet is, just as a 20-second explainer, is it's a form of protection for investors to know that if they invest at a certain price, that in the future, if somebody's able to buy shares for a lower price, that the price they paid will get adjusted. And it's typically something you wouldn't deal with until much later in a company's life cycle.
Great. And now we have a question from Hector. What is your opinion on a revenue share with a conversion clause?
Revenue sharing with a conversion clause. So usually you don't really get into revenue sharing with early stage notes like this, because most companies at that stage, at least VC-backed companies, are not always showing profit at that point. So revenue is really being pushed right back into the business. I'm not sure if that is a specific type of thing depending on market, because depending on the market you're in, whether it's in Silicon Valley, on the East Coast, in the Middle East, in Europe, in Southeast Asia, the common investment terms can differ. But in our experience, we haven't seen very many agreements where there's a revenue sharing component, especially very early on.
Great. And then he follows up with, do you recommend a pre-money conversion method?
So you're going to convert the convertible money you put in is going to turn into shares when the company raises its priced equity round. And it's going to convert according to the formula in the note, the safe, or the KISS that you use. And generally they all convert like right before the next financing takes place. So if that's what you'd want to call pre-money, then that's where the conversion would happen. Generally, it's going to happen right before the new investor's money comes in, because the new investor isn't going to want to be diluted further by the early stage people. I hope that answers the question. And Hector, if you have additional questions, feel free to email or send them to the team, and we can follow up afterwards.
Great. All right, and one that was sent in convertible securities, do you see term sheets with valuations above the val cap in SAFE or KISS? What can investors do to protect themselves against this?
So if I'm understanding correctly, what this question is asking is, if I invest $100,000 with a $5 million valuation cap, is it common to see the company then get a term sheet for their next round with a $10 million pre-money valuation or $20 million pre-money valuation? And I would say the answer is yes, all the time. So the valuation cap is really meant to be a benefit for the early stage investor to get a beneficial deal that they negotiated for taking that early risk. So companies all the time will raise at a higher pre-money valuation than that valuation cap because the company might do well or whatever the case might be. And I wouldn't say that this is something that you necessarily need to protect against, or that is even a bad thing. It just means that everything is working almost as it should. The one situation where this would be bad is if the company has put out some notes on an extremely low valuation cap. So for example, the situation I was describing where if, say, somebody invested $500,000 on a $1 million valuation cap, that means that they're going to get 50% of the company when it converts. And so then as a downstream investor, you might not want to offer a term sheet for, at too high of a valuation because you don't want this person to get such a deep discount. And at that point, the only thing you really can do is try to reach out and through the company or those investors and negotiate to see if there's the possibility of some kind of amendment or anything you could do to adjust those terms to make it more fair for the founders or the later stage investors, because it's really only a problem when the terms are so skewed because somebody has an extremely low valuation cap that it would result in a really weird cap table.
Great. And then moving on to a question from Marsha. She asked, safe docs, should we only agree on either a cap or a discount?
That's a great question. So for safe, if you're using a safe, you can agree on a discount or a valuation cap or both. Very, very, very common to agree on both. And then typically the terms will say that the investor is entitled to whichever one results in the better price for them when it comes time to convert. So something very typical might be a discount of 20%, and then wherever you set the valuation cap, and when it comes time to do the conversion, whoever is making the pro forma cap table to calculate everything will calculate it in both methods, and the one that results in more shares for the investor is the one that gets used. So if you're the investor, no harm in putting both. If you're the company, if you have some strong feeling about one or the other, you could just choose one, but there's for the investor, there's really no downside in doing both.
Great. And now staying in the safe arena, this question comes from one that was submitted. They heard from an investment banker that safe notes are risky for angel investors unless term sheets clearly state how preferred stocks are calculated for conversion. Is this true?
I would say generally no. There's nothing inherently risky about a safe versus a convertible note versus a KISS, or all of these are different flavors of a similar agreement. So they will all spell out how they're to be converted into preferred shares. That's not something that's left up to chance for later. So your safe that you're using should already have all the terms of how the conversion price and how the conversion into shares is calculated. It doesn't depend on that future financing round changing the terms, and usually it can't be amended unless the people holding the majority of the money invested on the safe agree to any amendments. So you shouldn't feel that the terms are going to change on you when using a safe.
Excellent. And some more safe questions. These were just submitted. In a safe, you are getting the terms of another investor. Is it appropriate to ask for the other investor's term sheets to review during your diligence process?
So usually, in our experience, there really isn't a term sheet for a safe or a KISS or a convertible note, just because there are very, very few terms to be negotiated. Really, it's just the cap and the discount. Maybe you want to talk about interest rates, but the interest is really not important for a venture investor, because you're really looking for home runs. You're not looking for 3 or 4% a year. So I would say that the term sheet we don't see very often. In terms of negotiating a different deal than other investors, I would say the best way to do that is through having a side letter with the company, or asking for maybe specific rights that you find important. So something like information rights is something that we at 500 always find important. That if we're investing on a safe or a note, and it's a very plain vanilla note, we always try to ask the company if they would agree to give us certain information rights that we can keep track of the financials of the company, or maybe be a board observer, so we can keep an idea of the company's progress, so we know how the company is doing, and we can properly evaluate or value the investments we've made. So you should always feel free to talk to the founder and address any individual rights you need directly, even if the lead investor has negotiated something different.
Great. We got lots of questions coming in. So fantastic. So if you have the option to participate in a priced round, is it more advantageous to invest at dollars for equity or invest using a safe?
So it really depends. If the company is doing a priced round, then you probably don't have any other option than to do the priced round. Like I said, the convertibles you're usually using for a specific stage of the company's growth, and that's going to be at the very early stage. They shouldn't really be giving you the option of priced round versus safe individually, because it's just not possible to keep track of the prices people are paying then. I'll say the pros and cons of it is, if you're buying shares directly, you know the price you're paying per share, exactly the valuation you're getting in on, exactly how many shares your dollars will turn into. With the safe or KISS or convertible note, you're putting money now, but it's going to convert somewhere down the line, and you don't know what the valuation of the company at that point is going to be. So by investing early, you usually get something like a discount, or that valuation cap that entitles you to a lower pre-money valuation for taking that early risk. So as an investor, you have the chance of getting a great deal by using a convertible note, but it's also dependent on the company actually raising a future round. So it, like everything else with startups, it could be great, it could not work out so great. So I would say on any given company, you're not usually going to have both options at the same time, but depending on the time it is, at the early stage, it's better for you to use convertibles. When they're doing a priced round, you know what you're getting. So if you're putting in certain dollars, the percentage ownership you're going to end up with, and everything is much more certain.
Fantastic. Now we got a risk mitigation question. What strategies for risk mitigation are used for convertible notes that may not perform?
What was the last part of that question?
What risk mitigation strategies are used for convertible notes that may not perform?
So if we're talking about convertible notes specifically, there's kind of a couple different things. So you have the repayment feature. So convertible notes, as opposed to SAFE or KISS, are actually due to be paid back at some point. So if you really think there's a chance that this company's not going to do well, your number one risk mitigation to get your money back would be to set a maturity date and then actually hope to have it paid back. I would say risk mitigation for early stage investing is bit of an oxymoron, just because there's not, there's really nothing that's certain at that point. And even if you're hoping to use the maturity date, there's a really good chance that the company is not going to actually have any money to pay you back at that stage. So relying on repayment is probably not a great place to be. Another thing you can do in terms of risk mitigation is ask the company for certain reps and warranties in the convertible note. So that would be something like including some contract terms saying, asking the company to certify that they have all the intellectual property they need to be operating their business, or that it's properly owned by the company, or that the company has no outstanding litigation or no current problems that they're aware of. So that would be one way to mitigate some risk. But again, at the very, very early stage, there's not much that can be done to really prevent the loss of your investment if the company isn't doing well. The other one thing I'd throw out is that you could have a very strong term such as most favored nation, which would mean that if I invest today and I have a most favored nation clause, any future agreements the company makes on convertible notes that are a better deal than what I've gotten, they'll have to match for me. That's a very, very strong term to ask for, and it's pretty hard to get a company to agree to something like that. So I don't know if I would really recommend going that route, but that would be the last risk mitigation type strategy I would throw out there.
Great. And Pedro asks, I have always heard that I should do convertible debt and not equity financing. What is the major benefit of a convertible debt round over equity financing in your
So I would slightly disagree with that statement. I would say if you're going to do something as an early stage founder, I would do convertible equity financings, not convertible debt. The reason being the situation we just talked about. If a company is raising convertible debt, and I raise $1 million, and the maturity date is a year and a half from now, then in a year and a half, once I've spent all of that money on trying to grow the business, trying to hire more people, if those investors chose, they could say, hey, this $1 million is due back. Can you pay us back? And then most likely you wouldn't have anything, and the company could be bankrupt. It could be insolvent. It is a rare occasion that investors actually ask for the money back, but that's the real risk with convertible debt. With convertible equity, you're able to just convert whenever the financing is actually raised. So that's definitely a better factor. That would be my recommendation as an early stage company. At some point, I would say it is better to do a priced equity round once the company is more stable, once you're able to agree on a valuation of the company that you think is fair, that you think the investors are getting good value, that you properly think you're selling the shares for the right price, you're selling the right amount of ownership. So I think I would start with convertible equity as a founder and then eventually move into priced rounds.
Awesome. All right, we have a little bit of a specific, I think, situational question from Elizabeth. She would like to understand what happens if she invests using convertible notes with a cap of 10 million and a discount of 20%, but in the following round the valuation is lower. For example, 4 million.
So in that situation, you would just use the discount. So if the valuation cap is set higher than the pre-money valuation that eventually comes in, if you ran through all of the math, the valuation cap would end up with a higher price per share. And like I said earlier, the investor gets the benefit of whichever one comes out to a better price for them. So in that case, the 20% discount is always going to be the better price. So that investor will just get their shares at a 20% discount.
All right. So here is another kind of situational one from Marsha. In Uganda, she recently saw an investment term that required the founder to personally accept the responsibility to buy out the equity holding of a DFI funder at 2 to 3x within 3 to 4 years. Do you find this shocking?
So I'm not sure what DFI stands for in this case, but I would say yes, it's a pretty unusual term to, one, ask the founder to make any kind of personal guarantee here, at least monetarily, and to be asking for a specific return just without any condition other than time is, especially such a large return without any condition other than time, is very unusual. It's not unusual to see people ask for a specific return upon some event happening. So if this same investor said, if you get acquired before my note has converted, then you pay me back 2x or 3x of what I've invested, that would be okay. But to ask the founder for a personal monetary guarantee just based on time is, very unusual.
And just for the record, DFI is Development Funding Institution.
Good to know.
So here's a question from Jack. Do you typically see companies that offer convertible notes asking for the right to convert them at the company's option if a qualified financing is not accrued by the maturity date of the notes, using a valuation that is perhaps slightly lower than the cap? Would the conversion be to Series C, preferred, or common?
So the question is the conversion at the company's option? Is that?
Yeah.
So I would say in almost all cases that we experience, the conversion is at the investor's option. And usually as an investor, you would almost always want preferred shares rather than common shares. I said almost always because as a lawyer, I'm pretty averse to saying the word never. But generally investors are going to want to hold preferred shares, and they're going to want to have the option to convert in their hands rather than in the companies, because otherwise there's really no control over what happens to your investment. So say I invested $100,000 today and the company decides to optionally convert tomorrow at a valuation of their choosing, and to turn me into common, I'll feel like I didn't get anywhere near the deal that I was anticipating. What would be much more common would be investing $100,000 and saying this converts if you raise a new round of a specific amount of money. And if you don't raise that round after some amount of time, I have the option to optionally convert. But it would be rare for that to be in the company's hands.
Okay, so if I understand this question correctly, it's from Dimitri. How would you prevent a situation where a company issues a safe with a lower cap than his initial investment? This would be after 1 year without ever telling him. Is there a way to prevent this?
So in this situation, I'm assuming you've invested on a safe, say your valuation cap is $1 million, or call it $5 million. Then later, a year from then, they raise money on a safe at $4 million, $3 million, or lower than your price. So the only way to prevent this as a safe investor would be you could either put in a term in your safe originally that says anytime that the company is offering more safes or more securities or anything to new investors, that they should also be offering them to you, so that you would know that they're even making this offering, and you could choose to invest on those terms or not. The other thing you could do is that most favored nation type clause I mentioned earlier, which is in your original safe investment, you would say, anytime you're selling additional safes, if it's a better deal than the one that I got, you have to give me the option to switch to that deal if I want. That's paraphrasing because it would be in more legal terms, but that's essentially what it does. So that would be the surefire way to do it. But like I said, that's a pretty strong term. And, depending on the sophistication of the company or whoever, all the parties involved, they may or may not really want to agree to that.
Awesome. All right, we have 3 more questions coming up. This one is from Samuel. As an investor in a convertible note, approximately how much should he reserve to invest in a future priced round relative to the size of his original investment?
So that's a really personal choice according to your investment thesis or strategy. So, you have to think about, even at a priced round, like a Series Seed or Series A, it's still very, very risky to be investing in startup companies. So, if you're investing on a convertible note and it gets to that first conversion, you've already probably had a pretty big jump in the valuation of the company compared to where you invested, because you're probably either getting a discount or you're going on a valuation cap that's lower than they actually sold the shares for. So, your first dollars in are going to be the ones that had the highest markup. Later, if you invest more, it's still a very high degree of risk. And there's not a specific figure or amount that you should necessarily be doing. Everybody has different strategies. So some people think, I want to aim for a certain target percentage ownership. So they might invest, even more when they're following on, because they either have more information at that point, or they know anytime a company raises this amount of money, I hope to have this percentage ownership of the company. So really, you have to think more about what your long-term strategy is and, what your conviction in that company is, because I don't know that there could be a one-size-fits-all formula that, if my note converts, then I automatically invest half more or double more.
All right. This is from Yorgos. In a convertible note, how often do you see a provision that the note will convert to preferred shares with particular rights enumerated in the note? For example, liquidation preference, pro rata rights, reserve matter, board seat, etc.
So I think it's pretty common to say that that a note is going to convert into preferred shares. That would be the default, that it would convert to preferred shares. Usually it says something like it will convert to the same type of preferred shares that the new investors are buying. So that part, very standard. And adding certain rights, like saying when it converts, that you would want to have, say, pro rata rights or information rights, also fairly common, and that's something we do at 500 Startups. I think if you were starting to say specific things about a liquidation preference, that would be less common, not something I've seen before. At least not if that liquidation preference is going to be higher than normal. If anything, I see more and more convertible notes now allowing the company to convert shares into lower liquidation preferences that match the price actually paid by the investor, just to be more fair to everyone involved. But to negotiate a specific higher liquidation preference before the conversion would be a little unusual.
Okay, we got a few more minutes. So let's do this kind of open-ended question. I like this as kind of a one to end on, is what advice do you have for a company issuing convertible notes? Just general advice.
Okay. I would say, if we're talking very, very general advice, I would make sure that you're having a board consent or action that actually authorizes the sale of these notes. It's a very, legal, technical thing to do, but it's important to have a good record of, it was approved by the company to sell these notes that will turn into shares. Please, please, please keep all the signed copies of all of these notes and make sure you collect all the signatures and date the documents so you know when interest starts or things like that. I would say to make sure when you're actually doing the conversion that you check each of the notes because they may not all have the same terms, and to be careful when doing the pro rata. You'd be surprised how often, even at 500, that we actually have to tell companies, hey, your calculations are wrong because they've given us more shares than we actually should be getting. So as a founder, I'd be very careful about the conversions because sometimes you're relying on third parties to actually do all the calculations and they may or may not do them right. And again, not to like push the type of documents we use more often, but a SAFE or a KISS, I think as a founder, I would be more comfortable using rather than a standard convertible note because it doesn't have that automatic maturity date repayment the way that a convertible note would. So you're at least somewhat protected from that very unlikely insolvency, bankruptcy type situation. But yeah, that would be some general advice.
All right, we're approaching the 45-minute mark, so I think we should start wrapping up. I don't know if you have any final comments on it that you'd like to present to the attendees.
Sure. So I guess what I'd like to say is I know that this stuff can be very, very dry and a lot of legalese, a lot of random terms that we're throwing around that may be more confusing or not as easy to follow. So I would say, definitely when you're going about this process, the internet is a great resource, and there's a lot of content out there that tries to break down some of the terminology, and I think that's the biggest factor in understanding what all of these documents mean. So I would definitely take advantage of that. And the other is, this is a pretty rapid fire session where we're not in person. We're not able to like go back and forth on questions, but at the Deal Camp program we put on, we walk through the documents in much more detail. We walk through all of the terms and what the definitions mean. And there's a lot of opportunity to go back and forth and discuss, personal questions and see what people really are confused about. And I think that's really the best way to learn is to go through examples and have some live back and forth. So I hope this has been helpful. And, if in the future you have more questions, please reach out to our education team and we'll do our best to try to spread more information to everyone.
All right. Thank you so much to everyone, all of the participants. Special shout out to our wonderful marketing team for getting this information out across the world. And of course, to our presenter extraordinaire, Amit. And if you, again, are interested in the VC Unlocked program at Berkeley, please go to education.500.co/Berkeley. And you'll have all of the information that you need about the program, how to apply, some brochures, and feel free to reach out to us, as Amit said as well, at vcunlocked@500startups.com. This topic and many more will be addressed at length over the 4-day class period. So let us know if you want to take part in this upcoming cohort. You can see it on your screens right now for one final time. And with that, thank you all so much. Hope you have a great rest of the day or evening, wherever you be. We'll send out a recording of this to all of the participants, so look out for that in your email. Thanks a lot. Bye.